Hello and welcome. I'm Andrew Carrier and I head marketing at Dolfin. I'm joined today by our Chief Investment Officer, Vassilis Papaioannou. Vassilis, thank you for joining us.
Thank you, Andrew.
Your team has just published its February monthly investment update, and I was hoping you'd give us a quick summary of that.
We remain in a risk-on mode going into February. We are negative on rates, especially in Europe, despite the recent move in January. In the investment grade and high yield space, we're very selective on an issuer and issue level. Turning into equities, we continue to favor Europe and US on a regional level, and energy, financials and technology on a sector level. Finally, the weak dollar will continue to support emerging markets and commodities in general.
So generally quite positive on equities. It seems like a lot of finance CEOs at Davos last week agreed with you. We heard some very bullish statements from them. But there have also been some market commentators warning of a possible meltdown in equities in the future, and I just wondered what your take on that was.
Well, Andrew, fear and greed are the two most common emotions when it comes to investing. And as we have seen in the recent years, where financial markets keep making consecutive records at all-time highs, investors either turn complacent or very risk-averse. But as the situation stands currently, from a fundamental, technical, macroeconomic standpoint, we don't see any reasons not to join the equities party.
So staying with Davos for a minute, I was fascinated to watch the rather public disagreement that the US Secretary of Treasury and President Trump seem to have there. What's your take on that?
That was definitely the highlight. Mnuchin broke a long-standing tradition of high-ranked US officials talking publicly in favor of a strong dollar. This is explained for two reasons. One is US administration focus on the domestic agenda, and Trump's isolationist policies when it comes to trade. And both reasons will definitely have an effect on the dollar, not only as a global currency, global reserve currency, but also as a safe haven status. So as we see that agenda being deployed and being implemented and the focus being turned into domestic issues, we'll see that export-oriented countries, Japan and Germany, or China in general, filling that gap.
Sticking with the US for a minute, at the time of filming, I think we're looking at a changing of the guard at the Fed this weekend. So Yellen's out, Powell's in. Do you think markets are going to react to this at all, or do you think that's already been priced in? What's your take?
The markets expect a continuation of US monetary policy, so do we. We expect 3 hikes for 2018. In Powell's first meeting, most probably he might sound a little bit more hawkish, or he wants perhaps to set the tone, but I think everything depends on US inflation data and in general the macroeconomic situation of the US economy.
I wanted to turn and talk about the British pound for a second. I need some personal advice, Vassilis. It's that time of year when my thoughts turn to booking my holiday. I'm paid my humble salary in British pounds. So I wanted to ask you, where do you think I should go, and crucially when?
Well, Andrew, that's a very practical question. We have been positive on sterling since November. We anticipated positive developments from the first phase of the Brexit negotiations, and this is exactly what happened. It feels like we're moving from a Brexit into a Brino, which is Brexit in name only. Obviously, Theresa May will face challenges here in London within opposition within her own party, and there will definitely be uncertainty for the ongoing developments around Brexit. But as it stands, we remain positive. And answering your question, I think US should be your first option around Easter. And then as we approach the summer, you should consider southern France or even my homeland, Greece.
Of course, Greece. How did I know you were going to say that? Thank you. So you and your team regularly produce investment ideas, and one that caught my eye this week was you put out an idea around precious metals, and you were pitching it as some kind of reaction to some of the mania that we've seen in the cryptocurrency space. Could you tell us a bit more about that one?
We have been neutral on precious metals for quite some time, for the past year actually, mainly because of benign global inflation and central banks voicing a more hawkish rhetoric. But recently we turned our attention to gold and silver mainly for 4 reasons. First is the ongoing weakness of the US dollar and anxiety around currency wars from Trump's isolationist policies. Second relates to cryptocurrencies. Investors have been relating cryptocurrencies to gold and have been wanted to expose to crypto as an anti-gold trade. As we see more hacking incidents on the negative side, or as cryptocurrencies mature on the positive side as an investment option, there will definitely be flows back into gold. Third, gold has been seen historically as a safe haven in cases of market anxiety. Equity markets have been making new highs and investors are concerned about valuations, so that could be another good reason to hold gold. And last but not least, the technical picture. So for investors who are looking on the trend, who are looking on consolidation levels outside geopolitical or inflation-related reasons, the technical picture looks favorable.
Vassilis, it's always fascinating talking to you. Thank you very much. Some great insights and ideas there from you and your team.
Thank you, Andrew.
Thank you for joining us. Please do visit our website to download February's investment update, and we look forward to seeing you again in our next video.